In the annals of financial history, few names resonate as powerfully as Warren Buffett and Charles Munger. These two individuals have become the personification of investing success, having created an empire that ranks among the largest and most successful in the world. As the backbone of Berkshire Hathaway Inc., they have consistently delivered value to their shareholders, navigating market complexities and embracing unconventional investment strategies. Their empire is not a byproduct of fortune or chance, but rather a testament to their exceptional investment acumen, relentless discipline, and unwavering commitment to ethical conduct. The aim of this video is to dissect their investing approach, revealing the secrets behind the remarkable success story of Buffett and Munger. A deeper comprehension of the success story of Berkshire Hathaway necessitates a journey back in time, tracing the roots of Warren Buffett and Charles Munger. The paths of these two legendary figures in finance were uncannily parallel from an early age, eventually intertwining in what would become a partnership that is one for the history books. Warren Buffett, born in Omaha, Nebraska in 1930, showed an uncanny understanding of numbers and economics from an early age. His father, Howard Buffett, was a stockbroker turned congressman, which exposed young Warren to the world of finance and investing early on. It was at the tender age of 6 that Buffett embarked on his first business venture, selling chewing gum door to door. As a paperboy for the Washington Post, he kept detailed records of customer preferences, demonstrating an analytical mind even in his formative years. Born a few years earlier in 1924, Charles Munger's journey was not too different. Growing up during the Great Depression, Munger learned early lessons about frugality, value, and hard work. His father, Alfred Munger, was a lawyer, instilling in young Munger a passion for continual learning and intellectual curiosity. Buffett and Munger crossed paths in 1959 at a dinner party in Omaha. Their introduction was facilitated by Edwin Davis, a mutual friend who saw striking similarities between the two. Buffett was initially apprehensive due to their 10-year age difference, but any doubts vanished once they began discussing their shared interests in business, investing, and philosophy. In Buffett, Munger found a person as passionate about investing as he was, and in Munger, Buffett found an intellectual equal whose insights he respected. Their meeting marked the beginning of a partnership that has now lasted over 6 decades, resulting in one of the most successful investment entities globally, Berkshire Hathaway. While both men came from relatively modest backgrounds, they demonstrated an early understanding and aptitude for investing and business, predicting their extraordinary future success. But their partnership's magic lies in their symbiotic relationship, pooling their wisdom to create an investment philosophy that has consistently outperformed market benchmarks. Buffett, known as the Oracle of Omaha, provides the face and voice of Berkshire Hathaway with his folksy wisdom and astute investment acumen. In contrast, Munger often operates behind the scenes, serving as a philosophical and intellectual compass. This dynamic was best captured by Buffett himself in a 2014 interview when he stated, "Charlie shaves away the nonsense, the baloney, and he lets me know when I start drifting into it." In the early years of their partnership, Buffett and Munger started acquiring companies, employing a unique investment strategy that prioritized long-term value creation over short-term gains. This approach was revolutionary in an era where most investors were focused on short-term returns. Their shared vision, complemented by their distinct strengths, formed the bedrock of what Berkshire Hathaway would become. The growth and success of their venture underlined the power of a shared ethos, relentless discipline, and complementary strengths, setting the stage for the extraordinary empire that is Berkshire Hathaway today. The crux of the Buffett-Munger investing doctrine lies within the realm of value investing, a concept that both individuals not only adopted but, over time, iteratively modified to reflect their evolving understanding of markets and businesses. Value investing, as a school of thought, was pioneered by Benjamin Graham, often referred to as the father of value investing. Graham, who was Buffett's mentor during his time at Columbia Business School, posited that the secret to successful investing lay in identifying and investing in stocks trading for less than their intrinsic value. However, the application of this philosophy by Buffett and Munger evolved beyond Graham's original teaching, as they began to place more emphasis on the qualitative aspects of a company rather than purely its numerical undervaluation. Buffett and Munger diverged from Graham's rigorous focus on stocks that appeared numerically cheap. Instead, they sought out companies with robust competitive advantages or moats, a term they popularized. These moats, as Buffett and Munger observed, could stem from factors such as brand strength, economies of scale, network effects, regulatory advantages, or superior managerial abilities. By investing in such companies, they aimed to profit from their sustained dominance over time. This approach took shape most prominently in the case of See's Candies, a company they purchased in 1972 for $25 million. At first glance, the acquisition appeared to contradict the principles of value investing, as the price was a considerable premium over the book value. However, Buffett and Munger saw something others did not: the company's powerful brand, customer loyalty, and pricing power, which they correctly predicted would provide significant cash flows over time. As of 2021, See's Candies has brought in over $2 billion in pre-tax earnings, far exceeding the initial purchase price. The pair's investment in Coca-Cola also serves as an illustrative example of their approach. When Berkshire Hathaway began buying the company's shares in 1988, the stock was not particularly cheap. However, Buffett and Munger recognized Coca-Cola's enduring brand strength and global reach, betting on the company's long-term potential rather than a short-term bargain. Moreover, Buffett and Munger are staunch believers in the importance of quality management. They often emphasize that they invest in management, not just the business. This focus on leadership quality and integrity has led them to form long-term partnerships with leaders like Ajit Jain, who manages Berkshire's insurance operations, and Greg Abel, the vice chairman in charge of non-insurance operations. Thus, Buffett and Munger's interpretation of value investing transcends the numbers presented on a balance sheet or an income statement. They have honed an ability to identify intangible value and to understand the longevity and resilience of a business's competitive advantage. In doing so, they have achieved extraordinary investment returns and transformed Berkshire Hathaway into one of the most successful conglomerates in the world. It's not just about understanding the value, it's about identifying the potential for that value to grow over time, given the right circumstances and the right leadership. Buffett and Munger's unique investment philosophy, often referred to as the Berkshire Way, reflects the duo's distinct blend of patience and discipline. Unlike their contemporaries, who frequently yield to the seductive allure of rapid returns, they have shown an unrivaled commitment to a long-term investment strategy, preferring sustainable growth over quick profits. They attribute their exceptional investing prowess to their buy and hold strategy. This approach, which encompasses buying stocks and holding them for an extended period, often decades, distinguishes Berkshire Hathaway in today's market, characterized by high-frequency trading and speculators chasing short-term trends. Their patience and discipline extend beyond the selection of stocks. It also reflects in their approach to portfolio turnover. Unlike many institutional investors who reshuffle their holdings frequently, Buffett and Munger are famous for their sit-tight philosophy. They believe that frequent trading not only incurs significant transaction costs, but also distracts from focusing on the inherent business performance of their investments. Their investment in the Coca-Cola company serves as a sterling example of their investment patience. In 1988, Buffett started buying Coca-Cola shares, investing about $1 billion, which represented a 6.2% stake in the company. The stock wasn't a clear bargain at the time, and many analysts had neutral or even negative outlooks. Yet, Buffett, recognizing the enduring strength of Coca-Cola's brand and its worldwide appeal, saw it as a worthwhile long-term bet. Fast forward to the present, Berkshire Hathaway owns 400 million shares of Coca-Cola, a stake worth more than $20 billion. This massive return on investment did not happen overnight. It was the result of patient capital allocation and a deep-rooted belief in the underlying business's strength. It's also worth noting that the dividends received from their Coca-Cola investment now exceed the original investment every year, underscoring the power of their long-term, buy-and-hold strategy. This approach hasn't always been easy to maintain. During periods of market euphoria or despair, staying disciplined can be challenging. Yet Buffett and Munger have shown an ability to remain unfazed by market sentiments, maintaining their course even in the face of overwhelming pressure to conform. In the late 1990s, during the dot-com boom, Buffett was criticized for not investing in technology stocks. Despite the prevailing market euphoria, he held firm, as he did not understand the business models of many tech companies, and many were not profitable. When the bubble burst in 2000, Berkshire's approach was vindicated, while many investors suffered massive losses. Thus, the Berkshire Way represents more than just a set of investment principles. It embodies a philosophy of life that values patience, long-term thinking, and discipline. These attributes have been instrumental in Buffett and Munger's success and continue to serve as guiding principles for Berkshire Hathaway. Another defining aspect of Buffett and Munger's approach is their Contrarian mindset, notably reflected in Berkshire Hathaway's acquisition strategy. Instead of following market trends, they have consistently demonstrated an ability to step outside the prevailing consensus, fearlessly making unorthodox investment decisions. When Buffett took control of Berkshire Hathaway in 1965, it was a struggling textile manufacturing firm. Despite its challenges, Buffett saw something others didn't. While the textile operation eventually wound down, Buffett used Berkshire as a vehicle to acquire other companies and invest in stocks, transforming it into a diversified conglomerate. His first significant acquisition was National Indemnity, a then little-known insurance company, in 1967. This acquisition marked the beginning of Berkshire's prosperous venture into the insurance industry. Their Contrarian approach was again evident during the 2008 financial crisis. When most investors were fleeing the market, Buffett and Munger saw it as an opportunity. They made substantial investments in companies like Goldman Sachs and Bank of America, providing them with much-needed capital in exchange for favorable terms. These investments have since generated billions in profits for Berkshire, illustrating the rewards of their daring, Contrarian investment approach. The duo's unconventional wisdom extends to their selection of acquisition targets. Unlike many companies that chase high-growth businesses, Berkshire has a penchant for acquiring boring businesses, companies with simple, understandable business models that generate steady cash flows. Examples include insurance, railroads, utilities, and even furniture stores. While these industries may lack the glamour and rapid growth rates of technology or biotech, they align with Buffett and Munger's principles of understandability and reliable, long-term performance. Furthermore, Buffett and Munger's acquisition strategy hinges on their unique corporate culture. Berkshire Hathaway is often the acquirer of choice for family-owned companies looking for a permanent home. Unlike private equity firms, which often load their acquisitions with debt and sell them off within a few years, Berkshire promises to keep businesses intact and maintain their operational independence. This approach has allowed Berkshire to attract business owners who care about their company's legacy, further bolstering its portfolio with high-quality businesses. Buffett and Munger's Contrarian philosophy, as demonstrated through their unconventional acquisition strategy, has consistently set them apart in the world of finance. By defying conventional wisdom and remaining true to their principles, they have been able to uncover value in places overlooked by others, contributing to the enduring success of Berkshire Hathaway. Their careers serve as a stark reminder that in the world of investing, the majority is not always right, and sometimes, the most rewarding path is the one less traveled. Buffett and Munger's profound impact extends far beyond their impressive financial track record. Their influence has fundamentally reshaped the investment industry and its practices. Their teachings have not only molded a generation of investors, but also embedded principles of ethical conduct and corporate responsibility into the heart of investment philosophy. Through their annual letters to shareholders and their famous Berkshire Hathaway annual meetings, dubbed the Woodstock for capitalists, Buffett and Munger have shared their wisdom with millions. These communications have served as masterclasses in investing and business strategy, distilling complex concepts into relatable, digestible insights. As a result, many investors, both professionals and amateurs, look to these teachings as a compass to guide their own investment philosophies. Their principles of long-term value investing have inspired numerous disciples, including some of today's most successful investors, such as Bill Ackman, David Einhorn, and Seth Klarman, to name a few. Beyond individual investors, their approach has permeated various investment entities, from hedge funds to private equity firms, to mutual funds, and even sovereign wealth funds. In addition to reshaping investment philosophies, Buffett and Munger have championed a more ethical form of capitalism. They have underscored the importance of operating with integrity, rejecting short-termism, and avoiding deceptive practices. Through their actions, they have demonstrated that ethical conduct and profitability are not mutually exclusive, but can be mutually reinforcing. Buffett's decision to donate the majority of his wealth to philanthropy, primarily through the Bill and Melinda Gates Foundation, further extends his influence. This act of extraordinary generosity, coupled with his encouragement of other billionaires to do the same through the Giving Pledge, has set a new standard for philanthropy in the 21st century. Munger, although less visible, has equally contributed to their shared legacy. His emphasis on multidisciplinary thinking, the concept that one should use a range of intellectual tools from various disciplines to solve problems, has deeply influenced business and investing practices. His philosophical teachings and aphorisms, such as "all I want to know is where I'm going to die so I'll never go there," have become essential parts of the lexicon in business and investing circles. In conclusion, the legacy of Warren Buffett and Charles Munger extends far beyond their astoundingly successful track record at Berkshire Hathaway. Through their wisdom, ethical conduct, and extraordinary generosity, they have profoundly influenced the investment landscape, shaped a generation of investors, and redefined the concept of wealth and its purpose. As their remarkable journey continues to unfold, their teachings remain as relevant as ever, inspiring and guiding those who aspire to follow in their footsteps. As we conclude our journey through the remarkable saga of Warren Buffett and Charles Munger, it's clear that their wisdom extends far beyond their financial acumen. They have taught us principles not just for investing, but for life, the value of patience, the power of understanding, the virtue of discipline, and the importance of contrarian thinking. Their enduring legacy serves as a compass in the turbulent seas of investing, guiding us to make decisions based on rationality, integrity, and long-term value. As we navigate our own financial paths, may we carry their wisdom with us, using it to illuminate our journey and help us build our own financial empires. If you've enjoyed this exploration of Buffett and Munger's investment philosophy and want to discover more about the world of finance and investing, be sure to hit the like button. Subscribe to our channel for more insightful content, where we continue to demystify the world of finance and investing, providing you with the tools and knowledge to make informed investment decisions. Your journey to financial literacy is just beginning, and we're here to guide you every step of the way. So, don't forget to turn on notifications so you won't miss our next video. Thank you for watching, and as always, keep investing, keep learning, and keep growing. Until next time.